Let's get into our results service now and start with the listed property sector. It's been such a fantastic performer. It was in the first quarter of this year anyway. It's coming off a little bit now, but nonetheless it has been a great friend to investors locally. The company concerned today with its half-year results is Rebosis. In the studio in Johannesburg is Sisa Ngebulana, the CEO of the company. Let me just read you what the company says about these half-year results. It says a solid performance, and the company has expanded its high growth and defensive portfolio. It's almost like a Goldilocks situation. You've got the growth and the defensive natures. Sisa, thanks very much for joining us this lunchtime. 12-month return to linked unit holders, 30.1%, 44.5% cents interim distribution, which is up 3.5%. It's been a busy 6 months for you.
Yes, thank you, Lindsay. Yes, it's been a busy 6 months, and we're pleased with the results. They're exciting set of results. As you said, 44.5 cents distributions, cents per unit. We're very pleased with that. We're up on last year, a comparable period. Total return to investor of about 30.1% total return, made up of 9% income return and 21% capital return. We also are 8.7% up on our NAV, which is quite good. I think more pleasing is the fact that we are 12.8% down on our net operating expenses. We're also down on our vacancy to 2%, which is quite great from an operational perspective. Also from a capital management perspective, our debt is down from 37% to 22.6%. So all very good positive factors.
Yeah, very good indeed. We'll get into the nature of your portfolio and how you've managed to particularly keep costs down a little bit later on. But you also had a rights issue during this period, Sisa, 650 million rand, and that's was sort of linked to an early distribution. Can you tell us about that?
Yes, we did that successful rights issue beginning of the year in January, and it was well oversubscribed. Again, it talks to all the right things that we do, that we're putting in place, and that helped obviously our gearing to come down from 37.8 to 22.6 currently. The good thing about it for us is that it gives us headroom to be able to move quick on transactions. We are a growing company. We're always looking at good quality acquisitions, and quality opportunities out there need speed, need quick decision making. And that just gives us that headroom to be able to close those transactions with cash quite quickly in the market. Obviously, it also helps us just from a gearing perspective, the fact that you're able to have room to move. So
let's talk about the high quality nature. Yeah, let's talk about the high quality nature of your portfolio now. It's more or less 50-50, isn't it, between retail and commercial? In fact, it's 52% retail, 48% commercial. Can you expand a little bit on the type of retail exposure you have?
Yeah, we have, overall we've got only about 12 properties, so it's very easy to manage, very easy to understand, it's easy to talk through the fundamentals of each and every property. So just starting with the retail, we've got 3 assets, they're dominant assets, and the key is that they're dominant. So some of them are community centres and regional centres. I think the icon is the Hemingway's shopping centre, which makes up about 28% of our net income. Located in Hemingway's, it's a very dominant centre. It's about 75,000 square meters. Our asset optimization team, we always look at how do we optimize these assets all the time. We added another GLA there. Checkers opened with about 3,500 square meters in an area which we converted, which was a parking area in the reporting period. So they opened the 28th of March successfully. We also have had expansion opportunities with Edgar's, looking at expanding from 3,500 to about 6,500. Jet, all board approved with Jet also moving from 1,000 to about 1,600. Advanced negotiation with Zara, looking at adding another 2,200 square meters. Hypercop, another 1,000, where we're converting an open parking area also into retail space. So adding new streams of income to the portfolio and sweating the assets a bit, which is quite a core focus of our business.
And you've got 98% occupancy rate, only 2% vacant. Is that across the board? Is that retail and commercial, or are you mainly talking about retail here?
The 2% is across the board in essence. So The retail is about 3.5, and the 2 is across the board. Our office portfolio is virtually fully occupied. And I think if you look at 2% in the market, we've got the lowest vacancy in the market, arguably. I haven't looked at all the counters, but I think nobody has reported anything close to where we are. And we're still looking at even getting that further down. So we're quite hopeful that and optimistic that in the current year we actually will reduce that vacancy even further. And again, adding more GLA to and sweating our assets in the existing retail assets. So we have Hemingway.
Let's talk about commercial now if we can.
Yeah.
Let's just quickly go on from retail to commercial, because the commercial side is very interesting. I think when you say that you've got a high growth and also a defensive portfolio, the defensive side is the commercial side, because a lot of your buildings are let to local and national government.
Yes, we have national government at about 37% of our income. Overall, which largely is the office portfolio, and they're let on long-term leases. They are recently upgraded buildings, and they're really quite they weatherproof buildings in the sense that we're protected with the sovereign underpin. Obviously, from a payment perspective, we don't have an issue. We get our rentals on time, and on long-term leases. So you don't have the risk of insolvencies, you don't have risk of downsizing in tough economic times, et cetera, et cetera. So it really is quite a bulletproof portfolio. Again, the defensiveness comes from the fact that on the retail side, a lot of our tenants are national, so we've got over 80% exposure to national tenants on our retail side, which is quite good. I think the norm in the market generally of centres of that nature, they have about around 65%. So we commend ourselves for having such a great portfolio, and so that's the defensive side. Whereas on the potential upside, we at the early stage of regional shopping centres, so things like turnover rentals haven't kicked in, and we're hoping that will trigger through as the more they mature over time. We already are seeing turnover growth figures which are double-digit in those centres. Average across all the 3 shopping centres, we've seen about 10%, led by Mdansane City at 12%. Turnover growth, and Blue Street Mall at about 11%, and Hemingway's Mall at about 8.5%. We've seen trading densities doing very well. Hemingway is about 23,000 trading density a square metre, and Blue Street 27,000, and Mdansane 21,000. Rent to sales ratios are very good, which means the tenants are on a sustainable path with their rentals in the shopping centres. So really the fundamentals are great.
Sounds very good indeed. In fact, you've answered one of my questions. I was going to say, are the government good tenants? Do they pay up on time? But you've said that already. And when I look at the split, let's call it 50-50 between retail and commercial, in the future, what is the ideal for you? Because there's all sorts of talk about the retail sector of the South African economy starting to tail off, with unsecured lending maybe being tapered a little bit, and also retail sales numbers getting a little bit choppy, and there is a fear that the South African consumer might come under pressure. So when you sit down with your team, do you say to yourself, well, let's try and get more commercial rather than retail, or are you happy with the 50-50 split?
Tell you what, our investment philosophy is we invest in dominant retail centres. So where you have a lot of pressure, when the economy turns and the bad cycles come on retail, with the consumer being under pressure, retail sales being down, the centres that largely get affected is the small centres. Convenience centres, they fall by the wayside. Small tenants, fall by the wayside, followed by neighbourhood centres, then community centres, etc. Our philosophy is dominance. So wherever we invest in these centres, we invest in dominant centres. Dominant centres generally tend to have more resilience in tough times. And I think if you look at our centres with an average growth in turnover of 10%, which is a double-digit growth, against compare that to retail sales, which are very pedestrian, and compare that to consumer confidence, which is at its lowest at the moment. So we've seen that coming through, underpinned by these fundamentals, so which is quite nice. And I think because we invested in centres that are more resilient and dominant, we really don't have those concerns in our portfolio.
In order to grow the business, of course, I mean, apart from keeping the occupancy rate up at 98% and hopefully closer to 100% over the near term, you've got to acquire. You've acquired over the last 6 months to the tune of 1.76 billion South African rand. But what about the idea of the fact that there is very few, as you call them, dominant centres available on the market? And if they do become available, there's lots of your competitors also competing for them. It must be quite difficult to find new properties.
Yes, indeed. You know, if you look at retail centres at the moment, they're few and far between, particularly regional centres. So you're not going to find them easy on the market. If you do find them, they command a premium. And I think the cap rates, you've seen some of the assets that have passed through recently, tracking 6% yields or cap rates. So it's a tough game to find those. But again, you know, we've got relationships with some of the players in the market who are invested in these assets, who might be looking at disposing them down the line. So relationships come in quite handy. And secondly, you know, with the rights issue that we did, with our level of gearing having come down, we're well positioned now to be able to use cash and close those transactions a lot quicker in the market.